Good morning, ladies and gentlemen. Starting with something slightly different because circumstances are forcing us to. Pyongyang to Beijing, 490 miles. Let's have a look at another distance. And here we have Washington to Ottawa, total distance 450 miles. As near as damn it doesn't make any difference. Now, imagine if somebody had a problem with Canada, I know it's pretty hard to imagine, and threatened to nuke Ottawa to solve their problem with Canada. What do you think the United States would say? Would you think they would say, yeah, no problem, you go and solve your problem with Canada any way you know how to or think you can? And, it doesn't really bother us. It's not our territory. You do whatever you like. Well, last time I looked, nuclear fallout is not a great respecter of actual borders. So, actually, what has happened is that a North Korean US problem has suddenly become a Chinese problem. And I firmly believe that this will be solved by China because China cannot possibly afford to have nuclear fallout anywhere near its borders. Certainly not within 450 miles of its capital. But even if we're not talking about a nuclear war, we are certainly talking about millions and millions of refugees. Just like the United States would not be too pleased if 2 or 3 or 4 million Canadians suddenly started crossing the border as refugees. I am sure that the Chinese are just not as enamored at the prospect of millions and millions of North Koreans becoming refugees in China. I think that preamble was necessary because I am of the firm belief that the tensions between the US and North Korea are not a long-term market problem. What is a long-term market problem is the behavior of the spreads over the past week. Here we have the 2-year note in the States, which is now trading below the middle of the Bollinger Band and is threatening this very important line that has held it for many, many months. We're talking about 129 yield in the 2-year note and this lower line, which is around the 115 yield. So we seem to be slowly moving towards a new trading range where this was the highs and we could be easily going towards the 115 yield in the 2-year note. The same problems exacerbate as you go further out down the curve in the US fixed income. We have finally broken the uptrend line in the 5 years, and now the picture is starting to look very different from a few weeks ago. We have still the 200-day moving average going higher, but I suspect it will turn over the course of the next 2 or 3 weeks. We are most probably oversold in terms of we're through the daily Bollingers, but it's going to be very hard to break this 0.382 retracement, which is around 1667. But this formation is beginning to look very heavy, and it's beginning to suggest that the next big move is going to be to the downside, back down towards this huge trading range, which was there for the most part of 2015 and 2016. We could be heading towards lower yields, which is a something which the market is probably not prepared for, and there has to be a reason for it. If we go to the 10-year note, the same pattern is evident. We still have the 200-day moving average on an upslope, but we have a very heavy looking formation here, which could easily break down towards the 190 level in the 10-year note, and in the 30-year note, especially if we look at something like the TLT ETF. Well, this is beginning to look like it wants to accelerate upwards at some stage, certainly going towards 132 and possibly even up towards 136. So we have a longer term picture where fixed income is in demand. Could it come back down towards this level of around 123 over the course of the next 2 or 3 weeks as problems in Korea are resolved? Yes. But this was happening before Korea. Korea is only this small move here. The problem, the real problem, is lack of any kind of inflation, whether PPI or CPI. Something is not quite right with this picture. Equally so, something is not quite right in the European fixed income market. This is the Schatz, the 2-year. Well, this is week 1, 2, 3, 4, 5, 6 of lower yields. Don't think that 6 weeks of lower yields is quite what a market which should be anticipating the end of QE in Europe was really predicted to do. In the 5-year note, we have much the same picture. We broke through, tested much higher levels through the Bollinger Bands, and now we've been coming back down towards the middle of the Bollinger, with this very important line at minus 30 basis points, minus 30 basis points, again, just supporting it. If we go through it next week, we will be exactly where we have been since the beginning of 2016. Something not quite right about this. 10-year notes, much the same. If we now go back to trading to 25 basis points or so, it will have negated all the action we did throughout 2017 and much of 2016, and it'll be saying that we can forget about higher yields in Europe. The Italian chart is the one which is the least bearish, and basically what this is suggesting now is that we might be ready for a large move in German spreads against Italian spreads, i.e. that Germany will fall in yield while Italy remains pretty much constant in yield. So another risk-off move possibly coming in the next few weeks. The actual damage done to the S&Ps over the course of the last week is, on a longer term scale, minimal. All we have done is gone down to the lower Bollinger Band, opened up the bands a little bit. We have corrected the large imbalance that we were overbought on the volatility scales, and now we probably are ready, once the geopolitical risk disappears, to move back up to where we came from and probably make a new high. That won't be a signal for the all clear. That, we believe, will be a signal to take on very much long-term position shorts. And the reason for that is the huge damage we have had in the spreads over the course of the last week, and we believe that has very, very little to do with North Korea. Before we look at the spreads in detail, let's look at what volatility did. And as you know, we were completely wrong last week in the steepening of the yield curve because the event overtook it. The yield curve would have steepened considerably without the event, but that is neither here nor there. What we have to do is now be buyers of volatility on dips. This is XIV, so basically the opposite of VXX. What we think is most likely to happen is that as the S&Ps recover, as the geopolitical event fades, we will have a lower high made in XIV. So it is more likely than not, and what we would really like to see is an S&P market which goes up, possibly makes new highs. We would love to see new highs, and a divergence with XIV which only returns to about the 88 level, possibly 89, and starts making what would technically then be a right shoulder ready for a break later on in the year down towards the 50 level or even the 40 level. This is a chart of the cash VIX, so basically the index to which all futures are settled, and you can see the very large spike that it had towards the end of the week. People who have followed us for a long time know that we have these levels at 1627 and 1950 as very significant. Any close, we believe, above 1627 takes us into a new volatility period, i.e. if it closes above 1627 it will trade 1950, or it's more likely to trade 1950 than not, and if it settles above 1950 we are in a volatility event where volatility can go much higher. For whatever reason it might be, it will certainly go into the 20s, if not into the 30s. We didn't have that this week. We closed at 1550, so below the 1627 level, and we think that slowly, as the volatility event evaporates, we'll probably move back towards 12, if not 11. But certainly we do not expect the market to make new lows this time. We don't expect the market to trade around the 10 area anymore. People have probably learned their lesson now, and even on new highs you will not get the market making new lows, which will set the market up for a big divergence between cash and volatility. If we now look at what the spreads are telling us, the story is beginning to become quite interesting. This is XLP XLY, which is one of the major spreads that we follow. While it was threatening to make new all-time lows at the beginning and middle of July and even the beginning of August, now it's gone through the 50-day moving average and it's threatening this channel, which has held it all the way since July of last year and told us that the next move in equities would be higher. This is the rally that took us all the way from the before the Trump election all the way to the new highs, the 2200s, the 2300s, the 2400s, and now this channel is under threat. Whether we break it by a tick or two is not so important. What is important is that action here will turn the averages and set us up for a substantial move higher sometime towards the end of this year or maybe the beginning of the next. You can see what the price action looked like in earlier years when we had a bear market in a second. This is what I want you to look at in XLP XLY. 2007, we have a very interesting battle between April and July, August of 2007 in XLP XLY around the 50 and 200 day moving average. All market historians amongst you will know that the bear market in in equities didn't really start until very late November, December of 2007. Well, this spread started moving well before that. It was, remember the period extremely well, extremely puzzled, and that this was what decided us to go short in 2007, just before the move started in earnest, several months before the S&Ps started falling in earnest. This is the kind of thing that we're afraid of, and this is the kind of thing that we will be watching very, very closely. It took between June and August to really make this transition. We might be in the same transition again. It might be between August and October, November, but when the move starts, it is vicious. Even more worrying is XLY over SPY. XLY consumer discretionary, SPY everything else. As we know, the consumer is a huge proportion of the US economy. We have made a lower high throughout this move in equities all the way from the 2100s up to the 2400s. And now we are beginning to test the uptrend line which has held since 2011, and we are now beginning to trade below the 200 day, and the 50 day has crossed the 200 day. If we enlarge that, this is beginning to be very, very worrying. We have the 200 day slowly moving towards a bear phase. We have the market just supported by this trend line. If we can't go higher in the next few weeks, we will break lower for sure, and that will mean that the consumer has given up, which will be a huge sell signal for the whole of the economy. And this is junk against TLT. Credit always goes first, followed by the consumer, followed by everything else. We had the false move a few weeks back through the 200 day, back up, and now we are testing those levels again. This is beginning to be very, very, very worrying. This is not a good picture. Continuous lower highs, possible or lower lows. If we now start breaking in credit again, we will definitely turn the 200 day, and it'll mean that the whole rally that happened throughout 16 and 17 will be at an end. Junk over TLT, TLT being favored, people running into treasuries and safety. This is a chart of the 5-year to the 30-year spread yield. We failed trying to go higher, i.e. flatter. We are now, on Friday, we really started going more positive in terms of slope. So What this is telling us is that the short end of the curve is much better bid than the long end of the curve. That is what happens when the market starts anticipating that the economy might be going into a tailspin. It is early days yet, but this is ominous. If we now break the moving average that has been supporting us for the best part of 3 years, we will be looking for much, much lower levels and a steeper yield curve indicating the beginning of a recession. When you put it all together, we come back to our long-term favorite, which is the shape of the 5 to 3 month curve and overlaid with XLF. As the 2 to 5 year sector collapses because people see a recession coming, and this goes further down towards all-time lows, this is where it was in 2008, remember. Let's say that we went to zero. The banks would have absolutely no margins, and we would see the crocodile jaws here close via XLF. That would give us a huge move in S&Ps, simply because XLF is such a large component of the S&Ps. So we are looking for a very volatile time ahead, but not because of North Korea or any potential conflict there. We don't think that is going to be long-term interesting or important to the market. What we are seeing is moves in the yield curve and moves in the spreads, which are early warning signs that the economy might not be what it's cracked up to be. All we need is 1 or 2 months of PMIs suddenly, without explanation, coming down, and we think the market will be in for a torrid time. From now on, it is unlikely that volatility will make new lows, and it is more likely that we'll start making new highs. So on any move down in volatility, we are buyers of calls, and on hopefully new highs in the S&Ps, which we still think are likely because of the enthusiasm the market will have once the North Korea issue is settled. We are very, very large buyers of puts if our spreads confirm, especially XLP, XLY. There are times to watch these spreads very carefully, and we are entering into it. XLP, XLY is something that we'll be watching on an hourly basis, and this, we are now beginning to be convinced, will be closed via a large move in XLF sometimes before the end of the year. One last spread to look at, XLP, XLY. No, sorry, SPY, TLT. SPY, TLT is now beginning to roll over. We can't make a new high. At least we can't as yet. This spread actually has been very instructive. It bottomed right when the S&Ps bottomed. It has made for Elliott wavers, lovely pattern of the first wave, the second wave correction, the third wave, the fourth wave, and now the fifth wave. The only question is, have we exhausted the fifth wave? Maybe yes, maybe not. But what happens after the fifth wave is that we have a very large fall, which probably takes us all the way back to about this level of 140. So we're talking about a 40-50% move in the spread between XL sorry, TLT and SPY. 40-50% in that spread is going to be huge. We still think that it's more likely that we will have these levels tested again as SPY tries to make new highs on a resolution of the Korea conflict. But this is also a spread which very much bears watching. If we try to enlarge it, if this machine will do it, we can see that the 200-day and the 50-day moving average are beginning to converge. This support line, trend line, which has been holding it in all the way from the lows in 2009, is beginning to approach. Another few weeks of work here, and if we break the 200 and the support line, we will be in very deep doo-doo as far as the market is concerned. All of which brings us to the biases for next week. We're beginning to turn bullish on the 5-year and the 10-year note. We are probably looking to buy some dips. Bunds and bobble, our opinion hasn't changed. In fact, it's being more and more reinforced. There is no reason to be short of the contracts, i.e. looking for higher yields. The market is telling us that that is unlikely to happen for quite some time. There is no inflation in the commodity indices, even though gold has gone up a little bit through, knee-jerk response to the Korean crisis. We don't see any inflation whatsoever on the horizon, and it's unlikely that fixed income is going to go down. It's much more likely to go up when the economy gives up on the back of the U.S. consumer. We are looking for that turn in the spreads. We will be watching them very carefully. Anything to do with the consumer will be very, very interesting in the next few months. If the consumer gives up, we will have a very, very large move in the ES. But that is not for now. We still think that the danger is to the upside in ES. People have now liquidated all their positions, so as if the Korean problem subsides, as we think it will, the danger will be very much towards making new highs rather than making new lows. The long-term problem now becomes the Russell. It has closed below 1383. That gives us an early indicator that the moves will be to the big moves in equities will be to the downside. We are now looking to short Russell on any big bounce. VX, we still think the curve should get steeper as the Korean tensions subside, but the overall level of the curve will now be higher. We don't think that 11% will be breached for many, many, many months to come. The super cycle is still intact. We still think that buying European equities hedged, dollar hedged, is going to be a better trade, and especially emerging markets. But if we have a complete dump, those spreads will go haywire for a short while, but we are not too worried, because the emerging markets are in a trend against the developed markets, dollar hedge naturally. So they are cheaper, and we think that once the events are out of the way, they will resume their trend upwards towards against developed markets. DX, another weekly close, way below the levels. We don't think that we can have anything better than 95.07 in the next few months. The dollar is being sold throughout the Korean crisis, and that indicates that weakness will persist in the months ahead. Is the dollar anticipating something in the US economy? Potentially. We are now really beginning to be worried because of the spreads, and it could very well be that the dollar is showing us the way for the US economy in the weeks and months ahead. That is what we should be concentrated on, not whether Kim Il Sung or whatever his name is, says or does something over the weekend. It is going to be very interesting to see whether these spreads start moving next week or in the next 2 or 3 weeks. That is what we have to concentrate on, and we will be doing so. Don't worry. Thank you very much, and speak to you on Monday.